Well, anyway, it's a graph. And you see angel and seed median size deal. And we see that in 2018 was a very strong year for the smaller end of the spectrum as well. Angel and seed activity near the decade high of $7.5 billion, largely thanks to a strong fourth quarter. And startups have been able to delay their fundings. The median age of companies receiving angel and seed funding has risen, and so have the median pre-money valuation and deal size. The median seed stage deal in 2018 reached $2 million, and after several years of remaining relatively flat, the median angel investment rose 40%. That's the graph you've seen very briefly. And now for this one, the total number of deals declined. And angel and seed stage financing are almost half from their peak in 2015. They were 1,483 deals in 2015 first quarter. In the first quarter of 2019, we had 828 deals, which basically means that there's a lot more money going to less companies. Each company receives more money. So I want to start by asking you, why do you think this change is happening? Is it simply minimizing the risk? Choosing fewer companies, giving them more money, or does it actually cost more money to build a startup today? Arik, maybe you can start.
I think it's a long-term trend. Interest rates are low, and I think it's probably the longest period in the economy history that we've seen interest rates for so long. And that increases the appetite of the institutional investors to put more and more money into private equity. And VC is part of this asset class. So there is more money available to be invested in VCs. Also, we've seen the tremendous success of the technology sector in general in the last decade. So companies are just making more and more money. Technology is changing everything around us, which leads to very good results of the big technology companies. So everyone wants to be in technology. So combining these two factors together, there is much more supply. And that's why we started to see this, you can see the trend in the graph in a very clear way. More money is being funneled into the venture capital industry, and as a result, more supply to startups. And as a result, we see the amounts being invested. And that, as a result, leads to the salaries increase. More money can be paid to the programmers that actually are hired. And the whole system just keeps growing like this. So Aya, basically what I just said is that it costs more to start a company. Usually, when a decade ago it may have cost a few $1 million. Nowadays, if you want to get post-seed stage, you need a lot more money.
Yes, I think companies need, some need in special cases like they have regulation to deal with, like when we invested in Lemonade out of Sequoia, they needed a long seed, a big seed, I'm sorry. So they had a long time of period to deal with regulation. Also in the space of AI, the people just cost a lot more. Data scientist is a very, very expensive resource. And the competition with Amazon and other organizations is very, very high and very hard today to compete on salaries. Okay. So I think they do need a lot of money. So we have more money, we have better paid engineers. Do we receive better companies in the process?
Not necessarily, but I would like to compliment in general to the Israeli entrepreneurs. I think that we also see that the typical Israeli entrepreneurs matured over time. We see more and more seasoned entrepreneurs, first-time and serial entrepreneurs as well. We only invest in cybersecurity in Wild Ventures, so I can tell you from our perspective. If until a few years ago, the typical founding team were, relatively young, ex-A200 entrepreneurs that were all about technology, and that was pretty much it. We see now more and more founding teams with much broader vision, thinking not just about cool technology, thinking about sales, marketing, go-to-market, all these business, basically how to conquer the world and how to build a category leader company in their space. And these broader visions cost more money, right? So they try to encapsulate more and more activities from the earliest stages, which in turn increase the seed round. So we actually see it as a positive trend.
Okay. Sigalit, I mentioned briefly AI and relatively new fields in technology. Does this have anything to do with the trend of companies needing more money and investors handing out more money?
So we invest in early stage but deep tech type of companies, which means that they need more money in order to reduce the technology risk, which resides in the early stage. And by the way, it's also a global trend. So how much money the company will need in order to raise the next round with the right valuation, which means that what is the next milestone and how much money they will need. So everything needs to be reasonable to what the company is trying to do, how much they can achieve in this period of time, and how much money they will need in order to achieve it.
Okay, Adam mentioned it briefly before about the first stages, going fast, going all in. We've been hearing a lot about the new term called blitzscaling. There are several books dedicated to it, several preachers that preach for blitzscaling. And blitzscaling, just to give you an idea, is basically, Reid Hoffman defined it as prioritizing speed and growth over efficiency, even at the face of uncertainties. So companies like Uber is a great example of blitzscaling, compete fiercely to gain large market share, and to do it fast and spend a lot of money in the process. But this creates a new system of hierarchy where the companies on top, Uber, Lyft, and maybe one or two other companies succeed, and the rest are losers. The market divides differently. How do you choose a company? How do you make sure a company gets the right advantages from the get-go?
Well, I think that's pretty much the name of the game. In every vertical that we invest in, we want to have companies that are the category leaders. So no matter if it's in cybersecurity or in consumer, you want the leading company. So you want to be the investor in the Uber of the specific vertical that you're investing in. Obviously, it's all about the people. It's like the usual recipe of venture capital. I think that really what you're wanting to ask is how we do it in this time with so much money out there. And is it the right thing to just raise as much as you can and spend all the money just hopefully getting to the first place? Or it can also lead to dangerous trends, like companies becoming very inefficient, spending the money on the wrong places, and eventually they're not going to get to the right place, just burning through a lot of money. So I think that these risks exist today, and it's actually going to increase over time with more and more money flowing into the market. And that's pretty much a responsibility that is shared between the founders, the management of the companies, and the investors, to make sure that it doesn't happen.
How do you feel that you minimize the risk when choosing a new company? Because growth ventures have the advantage of knowing the company after it's been in the market for a few years and see how it operates. What do you do?
So I do think that the team, as Arik mentioned, is one of the most important things, because becoming category leader in its space, it's not trivial. And we often see that companies come to raise money when they have a very interesting business in an interesting market, but then they come across a wall. And we had the chance to totally change the company, change the market, and start over. So many founders do from a very large pivot to a very small one. Sometimes they start in one path and finish in the blitz, but in totally different space. So it has to be a very flexible entrepreneurs, very tenacious ones, and we aim to identify that.
Okay.
So the way that we minimize our risks is pretty much baked within our investment strategy and model. And the way that we do it is that we decided to be vertically focused, right? And I see that, I believe that this is a trend that we're seeing. We're seeing more and more specialized investors, specialized in specific verticals. And by that, you gain a lot of domain expertise and knowledge, and you're building your own, say, value-add programs to help and support entrepreneurs in your specific verticals. So the fact, for example, that we are headquartered in Silicon Valley and we build our networks of CISOs, of potential customers and partners in cybersecurity specifically, that mitigates a lot of the risks of early stage investments in Israeli technological entrepreneurs. And it starts from before we invest in a very rigid and very aggressive due diligence process all the way to helping our companies scale. And I think it's very hard to do it if you're investing in multiple domains or in multiple stages. But I think this is one of the key trends that we're seeing, specialized investors.
Okay.
We've decided to focus as well, but our focus is really to invest in companies that has a core technology that can make the 10x a real difference, which will be hard to replicate and can really take industry leadership, even though in some industry it will take longer, but at least they will be first to market and they will offer a very valid type of product.
Okay, so we talked about the trends and we mentioned some of the reasons, but the fact that company and entrepreneurs have to deal with large amount of monies from the get-go, obviously it creates, it has to create new strategy for the companies. Entrepreneurs have to build the companies differently. What do we see today that we haven't seen 5 years ago or 10 years ago? Is the process of building a company, the goals are different?
I think that what we learned and we implement it on a daily basis is that we try to close the gap between Israel and the global markets. Over time, we do have more and more experienced entrepreneurs that done it before. They worked before in maybe like the checkpoints of Israel.
Yeah.
So they learned how to bring a product to the market. But we focus a lot on working with these young companies, and we are like seed stage investors. So it's almost in all cases, it's our money that goes first into the company. And we've seen that in the first 2 years, the fact that we can bring our companies to Fortune 500 customers, which you would think that it's not possible for a young company to sell to such a big company, it's possible. It's a result of a lot of very focused and effort that we do. A lot of resources are being invested into that. But once you break this barrier and you have a young company that is actually working now with a Fortune 500 company in the US, you know that you're much better in the product market fit process. It's much easier to raise money again and to bring high quality US-based funds into the company. And that's something that we learned how to do. We do it all the time because we have amazing entrepreneurs that are really great technologists and visionaries. Many times they lack the commercial experience and the connections, and this is where we jump in and help them with that and just to accelerate the company again. The whole idea is to create the category leader.
Okay. Can you point some other strategy differences?
I think that 10 years ago, entrepreneurs proved their capabilities to build the right technology. And today, they're much more focused on execution and on the business side. And it's a great thing to see that Israeli entrepreneurs are already focusing on the business side. So one of the key things is to start not at the beginning in the local playground, but go directly to the US market. So it's very quickly moving the headquarters to the US market, many times bringing the early stage investor from Israel to support when you're in Israel, but then the follow-on investor from Silicon Valley, if that's where your market is and that's where you're going, then that can be supportive as well.
Mm-hmm.
I would like to highlight at least one major risk in that strategy of raising a lot of capital at the seed stage. In many times, there are some processes that cannot really be accelerated, right? So you think that, okay, we'll just invest more money and they'll have faster R&D and much stronger sales and marketing. But some processes, especially in the early stage, are much more nuanced, like reaching product market fit or understanding what exactly is your unique value proposition, what's the right messaging, what's your position in the market. These things take time, and oftentimes you can't really squeeze them to a shorter period of time. It takes time to go out and talk with more customers, and these are long processes, and that actually increases the risk of finding yourself in a company that burned a lot of capital, but still haven't figured out exactly what is
as a result, do we see more companies pivoting and changing their product?
So I think it's a bit harder to pivot after you burned $5 million instead of $1 million, for example, right? So this is the main risk of this trend of over-financing and basically reaching basically the same milestone. You could have been on the same. You could have reached the same milestone with much fewer capital, and then follow-on rounds become much more complicated and sometimes painful. So this is something that entrepreneurs and of course investors must take into consideration.
Okay, and I know we're talking about early stage investment, but let's jump to the end point and talk about exits. When you put a lot of money into a company, your goals and your end point has to change, because we used to celebrate $200 million exit and $300 million exit. First of all, we see less and less of those smaller exits, but it wouldn't satisfy the investors when you have put so much money into the company and then it sells for less than $1 billion. You all agree with me? That's why.
No, I think less than $1 billion it's not a problem. I think that each investor would probably direct his exit main goal according to the stage where he went and the valuation that he created and the multiples that he brings back to his investors.
Okay.
But it's every company, as it grows, you can see if it's strong enough, if the management team is strong enough, if the technology and the market fit is good enough to grow, to be a bigger company and to reach that wishful billion, or maybe it should be sold in 500, 600 if the right buyer comes, depending on what is best for the team, for the founding team, for the company, for the employees.
But we have less and less buyers that can afford to buy companies that had this kind of valuation.
I'm not sure that I necessarily agree.
Okay.
We see new players actually coming to the market. Just a couple of months ago, I think you wrote about McDonald's buying Dynamic Yield. McDonald's never acquired any Israeli companies. Continental, which is like a German automotive company, acquired a year and a half ago, Argus, which is a cybersecurity company. Another newcomer to the market. And I think that we have on the sidelines, and all the VCs are hosting, are hosting on a weekly basis delegations from the US, from Europe, from Asia, and all of them come to here. They want to buy companies here. They want to open R&D centers. We just went to the Commotion event Ford is opening an R&D center here. Volvo, like companies that you would never imagine that are going to have presence in Israel, and they are here, and these are companies with very deep pockets and a lot of interest. So I think that we have still way to go. Yeah.
Okay.
I think that every industry which is disrupted, and you can see the new players disrupting different type of industries, create very good place for acquisitions and appetite from the corporates to host innovations in-house, but also to acquire different companies and different opportunities outside to get the leadership.
Okay. Mayor before me has been mentioning the possibility of a bubble bursting. And I know you probably don't want to predict what will happen next year. But as I said in the beginning, we were supposed to see less money invested by VC in the first quarter of 2019. That hasn't happened. Do you think we'll see some kind of change in the trend soon?
I think it's going to happen in July 11th, 2021. You can write it down.
Okay, mark everybody, get your counters.
I'm joking, just to make sure that, who knows? Who knows, you know. Definitely we're not where we used to be like 5 years ago. Mm-hmm. Will it last, you know, 3-4 years? Who knows? Will it be the same as what we've seen in, you know, year 2000, like, you know, 80% decline in NASDAQ, or 70%? I don't know. So let's just continue to live and be more efficient and make sure that we make good use of the money that we invest. But I don't think that we can be, you know, really, you know, forecast.
But are any of you worried about it? Is this something that is in the back of your head?
Yes.
That's of course.
Of course, and I think if you have deep technology and enough money in the bank, then you can go on the other side once it happens.
Okay. Thank you very much, guys.